Hello. Well, today we're going to do a nice little topic, disposal of assets. This actually isn't too tough, so good for us, right? A topic that isn't that bad. So disposal, of course, implies we either sold an asset or exchanged it for another asset or just threw it out because it wasn't worth anything. Now, we already looked at exchange of assets in a previous chapter. So now we're going to look at an example where we dispose of an asset by selling it. And of course, we are still using the fair value standard. So when we sell an asset, we need to recognize a gain or a loss. Now, one thing that students often forget when they do this type of problem is they forget to do this. Bring depreciation expense up to date to the date of sale. And what that means is you have to do a journal entry. It is not enough to just calculate depreciation expense. As you know in accounting, the only way to get something into your ledger account and into your accounting records is to do a journal entry. So if you calculate depreciation up to date but don't do a journal entry, then none of your amounts are right. Your accumulated depreciation will not have in that account what you think it does. Okay, so make sure you do a journal entry. Then we do a journal entry to de-recognize the asset. So let's just do an example here. I'm just going to make something up. So we purchase an asset. Let's just say it's equipment for $600,000 on April 20, year 1. Okay, our residual value is going to be $30,000. Now let's make that 40,000. I just want this to work out. $40,000 residual. And we're just going to use a very simple concept of an estimated useful life of 10 years. Okay, so let's figure out our yearly depreciation using straight line depreciation. And most of these questions could be based on straight line, which everybody likes, right? So here's our $600,000 purchase price. Here's our $40,000 residual. We need to depreciate $560,000. So we're going to do that. Now, 10-year useful life. I know this isn't tough math for us, but we'll just do it anyway. $560,000 to depreciate divided by 10 years, $56,000 a year. Now, we may not have perfect even numbers. Only in textbooks can you have a perfect even number, right? Companies don't really buy equipment for like $1 million and depreciate it for 10 years with no residual. In real life, you need to deal with some odd amounts. So the first odd amount we're going to deal with is the fact that we have partial year depreciation. So April 20 rounds to the end of April. And of course, April is the 4th month, which means we will have owned this 8 months out of 12. So our year 1 depreciation is actually $56,000 yearly amount times 8 divided by 12 months. So 37,333. Now, we didn't do the selling part yet. So let's get a few more years under our belt. Year 2, and let's go to year 7. Okay, so the yearly amount, of course, is $56,000. So I'm just going to add that $56,000. And I know there's a whole lot of ways you can do this, so don't sweat it. This is not the most efficient way, but it works on Excel, right? So here are 6 full years and our first partial year of depreciation. So here's where we are, and I just want to make sure we know where this is. This is end of year 7. And this is our, so accumulated depreciation, end of year 7. Now, here's what we're going to do. On November 17, year 8, we're going to sell this equipment for $200,000. Okay, so we just sell it for $200,000 at the end of year 8. Now, I know that's nothing like the residual, but it doesn't matter, because all we want to really do is do this as an exercise. Now, November 17 rounds to end of November. So when we go to do our year 8 depreciation, we're doing the calculation to the end of November, even though, of course, we're selling the machine on November 17. End of November, we're talking ownership during year 8. Sometimes students make a mistake and they say, oh, the difference to December is 1 month. Well, that's when you did not own it. You owned it from January 1, year 8 up to the end of November. So that's 11 months out of 12. So what we're going to do is we're going to take our yearly depreciation amount of $56,000. We're going to multiply it by 11 months out of 12. So we have to do $51,333 depreciation in year 8. So let's figure out accumulated depreciation. There's accumulated depreciation. Now let's figure out book value, which of course is purchase price less accumulated depreciation. So we start with our $600,000 historical cost. Then we're going to take away accumulated depreciation, and we're going to get our book value. Okay, so book value is $175,333. So let's think, is this a gain or a loss? We sold it for $200,000. So comparing these numbers, some of you, don't have a lot of practice at this, and some of you can do this, all day long in your head without trouble. But let's just go through it a bit by bit here. So we say the book value or carrying amount is $175. We sell it for $200. So we're selling it for more than our book value. As soon as you sell something for more than book value, that implies a gain on sale. So let's find out how much that gain is. I'm going to take the selling price, I'm going to subtract the book value, and we have a calculated gain of $24,667. So let's do our journal entries. And as we were talking about near the beginning of this video, this is a calculated amount for depreciation. You have to do a journal entry or it's not in your books. So the first journal entry always is to simply record depreciation up to the date of sale. So we go November 17, there's our depreciation expense, accumulated depreciation, and there's our journal entry. Okay, great. Now accumulated depreciation truly is $424,667. So remember that is a contra account. This is a credit balance in accumulated depreciation. So now let's just, we'll simply build our journal entry to dispose of this equipment through derecognizing the equipment. So the first part is great. Let's take our money. We get $200,000 because that's what we sold it for. Now, as soon as you don't have the equipment, you can no longer have the contra account for the equipment. You have to close out accumulated depreciation. So let's do the journal entry. That is a debit to accumulated depreciation. And of course, that was 424,667. So there we have it. Okay, now we determined that we had a gain. So let's recognize our gain. Gain on disposal of equipment, and we had calculated that number already. So the point here is don't just plug in the number, calculate your gain, do your journal entry, and then check it to make sure debits equal credits. And you've got a way better chance of getting this right if you go through each step rather than just hoping to plug in the right number. Okay, so the last part, of course, is we don't have our equipment anymore, so we need to actually get rid of the equipment. I'm trying to get that to even up here. Anyway, the equipment historical cost, $600,000. Okay, so here's the first entry, bring depreciation expense up to date. Here's the second entry, dispose of the equipment. Now, this is 624,667. This is 624,667. Debits and credits balance. We're pretty certain we did this right. Okay, so let's just extend this example a tiny bit, and we say, what if? What if we sold this for $170,000? Okay, so our depreciation doesn't change. That entry right there still happens. We just didn't get as much cash. So if we sold this for 170, our book value we've already determined is 175. So we're getting less than book value. Not as happy a day for us, but in any case, you can see that what happened here is we lost $5,333. So let's redo this journal entry as though it were a loss. We still have to take in our cash and debit out or close accumulated depreciation. Now the amount of cash changes, of course, because we sold it for 170, but accumulated depreciation did not change. It's still 424 and change. So there's our two credits. Now, as you know, a loss is a debit, just like an expense. So instead of a gain, we have a loss on disposal of equipment. And I'm going to call that my 5333 loss. Okay, now the only thing we need to do, which does not change, is we need to credit out or close out our equipment because we don't have it anymore. So the only thing we really want to do at this point is say, did we do this journal entry right? So what I'm going to do is I'm going to add up these numbers. Hey, debits add up to 600,000, right? We can be pretty happy about that. It looks like we did the right journal entry. Always check that in these and make sure it worked. Now, I didn't type in this entry again, but just remember, you still had to do that entry. Gain or loss, you have to bring your depreciation expense and accumulated depreciation up to date. But as you can see, actually disposing of equipment for cash is not that complicated an accounting process at all. Probably less complicated than exchange of assets that we did before, because we're always going to be using the fair value standard and just calculating a gain or loss on sale. So I hope you found that easy, and we'll see you next time.